Alrighty then. Seems like everybody got through the exam without any drama. Hope you all had a good spring break. Um, First thing I'm going to do is run through the exam. Obviously, if you didn't do the review, it would have been maybe a bit more difficult. If you did the review, it should have gone pretty much as advertised. So hopefully that all worked for you. Um, Whoops. So first exam review. Okay, so yeah, like I said, if you don't know certain concepts, and this will be true on the final as well, there's it's tough to write questions, number one, and so there ends up being some repetitive nature to them, but also some of the concepts, liquidity, opportunity cost, it's going to hit you time and time again, not only in life but also on these exams because here there's two questions that are both pretty similar. So anyway, and I'm not here to preach to you, but if you go back over your life here 20 years from now, you're going to be able to go, yeah, if I would have done that, if I would not have done that. Anyway, that's all opportunity cost. So it comes in, this is personal finance, but it could be true of anything. If you're doing one thing, you're clearly not doing something else. I'm not saying you got to, work constantly, but anyway, you got to manage your time because time is the one commodity that whatever um, need to worry about that. But time and also the again here we're talking about money. If you put money on something, not going to happen to something else. So retirement planning obviously as quick as possible. So this is the kind of the downside of some of the student loans if you go over you know on that. Now, most of you obviously are, probably Alaska residents or probably stayed in state to avoid some of the debt and everything else. But just this week, I mean, wow, who could have forecast what's happening with fuel prices? I mean, we expected them to go up with inflation and all. The money supply that's been created, the activity in Russia didn't help, but the trend line was already well established. And so, anyway, I don't know how that's going to go down, nor do we have the resources to convert everybody to electric vehicles or whatever, coal fired vehicles in any time soon. But anyway, I guess we are going to get there at some point. Um, if spending exceeds the amount of your income, best option is to reduce spending. So you have to be able to live within your means. So that is key. If you're, constantly, and especially now, this is tougher and tougher. I already sound like a broken record. Alrighty. Liquid assets. Liquid assets, the most logical one is cash. So these other ones are just kind of throwaways. Except for number three, real estate. Real estate is the best investment, if not, very close to it. Definitely a nice stable, and you want some diversification. Say you have some crypto, say you have some stocks, say you have whatever, but real estate's just a great component, but it is not liquid. And so some of these other things, like, we mentioned stocks, they might be liquid, but you probably don't want to sell in a down market. So that's not a liquidity problem, that's an investment problem. But real estate, even if the price is up, you just can't turn it into cash very quickly. So anyway, student loans, card debt. You don't have to read too much into this question. It says long term. Long term means over a year. So, all these type of things are housing loans, typically 30 years. Car loans, obviously over a year. Student loans, several years. So current would be, under a year. Short term would be under a year. Personal obligation, that's just kind of an extra thrown in. Whoops, rolling right forward. Sorry. Um, Best measure of a person's wealth is net worth. So, yeah, if you've got a bunch of stuff, but it's essentially owned by the bank or whoever's holding the note on all that stuff, yeah, you don't own a whole lot and you're maybe in a bit of a precarious position. Maybe not. If it's good real estate, you can have a fairly low net worth because it's all out on loans, but you're probably going to end up with a pretty substantial net worth in the future, um, when when you start paying down on those loans and your assets start appreciating. But if you're looking to see how much money somebody has, the net worth is one of the greatest indicators. So salary earned annually, yeah, your salary and your expenses, funny thing, are going to match. Your all of a sudden your needs are going to expand, and sometimes they legitimately will if you have to drive a long distance. But people tend to pretty much spend however much they're making, and that's just it's like somebody's garage. No matter how big your garage is, it all ends up getting filled up with somehow, some way. And if it anyway, so as your salary expands, your needs may increase slightly, but your wants are certainly going to increase. Total value of an investment assets. Um, yeah, that's interesting, but are they borrowed? Is it borrowed money? Is it margin? It's tough to tell. You could have a lot of investments, but they may not be all yours. Market value of real estate, including personal home. Again, do you own it outright? So best one is the net worth, which is that calculation. You get your assets and you subtract your liabilities, and that gives you a net worth. Why is it important to monitor your debt level? So again, living within your means. These artificial ratios, yeah, again, it's depends, and things are changing so much now. People would love to have whatever liquidity ratio, but if you've got to drive to work and it's going to cost you twice as much as it did just a few weeks ago, you're going to do what you gotta do. You still though have to monitor that debt level. Um, okay, money received today is worth more. Um, Whatever. I'm kind of misreading that question, but anyway, if somebody gives you $100 today, it's worth more to you now because you can invest it. And that's why anytime you can get something at an accelerated rate, or even if, any of those lottery calculations where, you can get $1 million today, or, an annuity, a series of equal payments that's going to pay you, a couple 3 million over the course of 10 years. It's not that easy a calculation. You got to literally do some calculating, which we'll talk about later in the course, but you have to figure out, you know, what you could turn that $1 million into in 10 years if you were to invest it. So anyway, um, earning interest over time, interest on interest. So that is compounding. Qualify for head of household. Obviously, you need to be single, or else you'd be, you know, filing in the married category, or married filing, singly, married filing jointly. You'd be in one of the married categories. Um, but you also need to have a dependent. And it needs to be obviously your own dependent that nobody else is claiming. This lady purchased some stock, 20 grand, sold it for 35. How much did you make? 15 grand. And was it greater than a year? Yes. So that's a long-term gain. Purchasing something on credit. Well, none of those interest categories are tax deductible with the exception of home mortgage interest. So, financial institutions, banks, how do they make money? By charging you more interest, right? So they loan funds at a higher interest rate than they pay depositors. Your ability to cover short-term decision or deficiencies, I can't read tonight, liquidity. Disadvantage of using the credit card is, it doesn't necessarily alleviate you from having an emergency fund, because you've got to be able to pay off that balance within the billing cycle, or else you're going to start paying finance charges. Stopping payment on a check only can be used if that check hasn't cleared. So if somebody rips you off and they've already cashed the check, then you got a problem. But anyway, go easy with the stop payments, and tell you the truth, they don't work that often because most checks now are processed electronically. But if you do lose a check or something like that, yeah, that's a good solution. Arrangement that protects the customer who writes checks for basically bouncing checks is overdraft protection. Now, there's got to be another account associated with it where that balance, because the bank's just not going to, let you float. But anyway, all those little nitnoid charges are really going to accumulate. It's probably some of you have found. All the following situations are valid reasons to borrow funds, except for day-to-day living expenses. So, next one. Using credit card frequently, pay off the balance every month, so you don't have to pay any interest. Which of the following is not true regarding cash advances? They are not treated like other charges. There will be a convenience fee. There is no grace period. Doesn't matter how quickly you pay it off. Well, it does. I mean, the interest though is going to keep accruing until you do pay it off. But there's no grace period. You will start paying on day one. Which of the following is true about Visa and MasterCards? Can be used as an excellent source of funds. Yeah. Visa and MasterCard are slightly different than American Express. American Express has got a few different products out there, but some of their products, they're not like a regular credit card if you're used to that. If you think that, oh, if things get tight, I can carry a balance on it. A lot of times American Express does not allow that. So I'm not a big fan. American Express is whatever. I've had to have it for different companies I've worked for, and the thing was, well, anyway, the travel situations where you buy the tickets, for a trip somewhere, and they send the bill that day. They expect it to be paid when you haven't even taken the trip yet, and you're nowhere near being reimbursed. And then they start to send nastygrams to your business or the company you're working for. So I didn't find them pleasant. Finance charges apply only to balances that were not paid in full. That's true. APR, annual percentage rate. So anytime you see, 12%, whatever, 2%, some sort of interest, it needs to have APR written behind it, or it's meaningless because it could mean different things. APR, annual percentage rate, means only one thing, and so you can compare rates if they're all in the same APR. There's no daily rate, there's no whatever rate. It's the operative, you know, acronym and words are annual percentage rate or APR. Good practice to review your credit card statement as quick as possible. So, yeah, you need to look for charges, duplicates, monitor your spending. That's nice as well. Collateral. Collateral is what makes a secured loan. So it is the car, the house, the whatever they're going to come take if the bill's not paid. So again, it's a good thing. You want collateral because you want to, present as little risk to that bank as possible so that they in turn give you the best rate. There's different portions. If a bank or somebody's charging you 8%, well, 4 or 5% of that is because they want to make some money on the loan, and then the other 4% is to cover the risk for the deadbeats who don't pay the loans and the charges they have to use, and chasing people down and other things. So you want that number to be lower. They're still going to have some, they still want to make some money, but it's that risk factor that can be minimized if they've got good collateral. What kind of loan generally charges the lowest interest rate? Secured loan, obviously. Don't be a cosigner, just number one. But anyway, if you do cosign something, yeah, The lender may not seize the assets of the cosigner. That is definitely not true. Yeah, they'll come to your place. If you cosign a loan for somebody, and again, if you're a bill collector, time is money. The person who needed the cosigner, they're probably a deadbeat or they're whatever. They don't have the resources to pay the loan back. So, you're not going to mess with that person. You're going to go after the person who had the good credit, who had to sign off on the loan to help this person out. And, whatever. It's not an emotional decision for them. They're just after the money. And the cosigner obviously had the resources to cosign the loan. Therefore, that's who they're going to come after. So try not to do that. When purchasing a home, which of the following costs will you not incur? The commission, right? So if you're selling a home, yeah, you have to pay. Well, you don't have to pay, but if you make the agreement, the listing, you know, find an agent to take the listing, yeah, the commission are typically your charges. But if you're the buyer, no, the commission charges are not your responsibility. So it doesn't cost you to use an agent, at least not directly. Now, if the person inflates the price a bit, and there's all sorts of other things, but we'll see. One disadvantage of a neighborhood with a homeowners association is the covenants. So, it's a two-edged sword. It can either help you or hurt you. If you're the one who wants to paint your house just slightly a different color, but still tasteful, they may just say no. Or it may be even stupider than that. They're hassling you about a trailer that you left overnight, one day, or you don't have enough trees in your yard because a moose ate them. And midwinter, they want you to get out there and, plant a tree or start paying a fine. It can get kind of silly. Fixed interest mortgage, the payment remains the same throughout the course of the loan. So believe me, especially now, man, 30 years from now, if you got a mortgage, say you're paying 1,800 bucks a month for a reasonable mortgage, that is going to be nothing 30 years from now. Whereas the people paying rent, their rent's going to be, whatever, 4 or 5 grand. So term ARM, adjustable rate mortgage. So know what you're doing if you get involved in one of those. You'll see the interest rate is lower. You'll see these things probably coming back into fashion right now because housing's basically going to be housing is going to be unaffordable for most people based upon the interest rates. And so, things are going to start get creative again. And they'll say, interest rates will come down. Just get into this, get the house secured through an adjustable rate mortgage, and then refinance a couple years, in the future. And yeah, that can work or it cannot. Anyway, it's, I've done it before and it worked the times I did it, but it was a little bit of a gamble. So anyway, talking about insurance stuff, ignoring risk is not a risk management tool. You can avoid them, accept them, insure against them, but no. Comprehensive coverage. That is kind of the cats and dogs. Damage to your car by wind and hail. So, damage to a neighbor's tree caused by your car. That's a strange one. But no, that's just regular liability type stuff. Damage to car or accident were your fault. Yep, that's straight liability. Injury caused by a driver without insurance. Anyway, none of those are covered under comprehensive except for the wind and hail. Deductible is the amount paid by the a deductible is an amount not paid by the insurance company. So if you've got $500,000 deductible, you have to come up with the initial money before they start paying anything. Which of the following is not covered by standard homeowners? The flood insurance can't be. Legally, they can't do that. To cover valuable property, you need a rider, a float, or an addendum to the contract. Anyway, you need to delineate it to make sure you do have cover. Best way to reduce your premiums, increase the deductible. Since health insurance is expensive, most people do some sort of group policy through their employer. All right, so that was that. Now we're going to talk about life insurance. So life insurance is kind of interesting. I'm not trying to ruin any friendships here, but you know, the more complex life insurance products are sold by agents that sometimes are friends or family or whatever, and they're a hybrid complex product that combines not only life insurance but also some sort of investment to it. And uh, anyway, most personal finance people do not recommend those complex products. They recommend a product that's just a term policy that doesn't even require an agent, just something you can buy online. You might want to, well, you will want to buy it from a reputable company and do a little bit of research to make sure that company's highly rated by, AM Best and the people who rate insurance companies. But that's kind of the gist of it. So I'm gonna present a whole bunch of different products here and talk about life insurance. But I'm, I'm just telling you up front that you're going to legitimately, hear me argue that term life insurance is probably the best product for you. Um, Life insurance is to, provides a payment to a beneficiary when the policy dies. So what's the purpose of it? Maintain financial support for dependents. So not just, whoever's depending upon you. It doesn't have to be just children, spouses, other people. If you check out, unexpectedly, early in life, and you leave people with a bunch of debts, that's not a good thing, and it can be easily avoided with proper insurance. That being said, as you get longer in life, um, the necessity for that insurance to provide for those dependents should be lessened as your financial picture has solidified a bit. If let's say the person with the most need for insurance, probably somebody in their late 20s, early 30s that already has children, may have a spouse that's not working, may have just taken out a new mortgage on a home. That person needs insurance because that person needs the family obviously is going to be affected in many ways by your death, but the financial part you can hopefully mitigate. Now, the leaving money for the heirs, your heirs are much better served if later in life, because you use that term policy throughout the course of your life, you invested money and you're leaving them a huge nest egg of, paid off real estate and maybe a stock portfolio and some other things. That's great. But to have them getting a life insurance settlement later in life, you could have left them a whole lot more had you invested the money rather than relied on life insurance. Life insurance policies, those hybrid products, typically don't generate as much, wealth in terms of interest. Plus, as I mentioned, they use a salesman on the front end, so that commission comes off the front. The whole time value of money, that big commission on the front end, that's money that could have been, compounding. So all this stuff is tied together. So anyway, um, psychology behind life insurance decisions. So yeah, easier to focus on happy events, hard pay ongoing premiums for benefit you might not need. Anyway, when I'm talking, term insurance, I'm talking, 30, 40, $50 a month to get you, $1 million worth of coverage. If you're young, if you're healthy, if all those other things are going on. If you try and do that later in life, it's going to get astronomically expensive. But like I said, by that point, you shouldn't need that insurance. So, role of life insurance companies. Yeah, but again, that you don't have to. If you meet up with an agent, obviously, they're going to prefer to sell the more complex products that involve you spending a lot more money with their company, and the ones that have a commission. Term insurance, you're not going to be spending much money on your insurance needs, nor are you going to be paying any commissions. So yeah, you have to do a lot of this research on your own, but most people are comfortable with that. Applying for life insurance could include medical lifestyle history. Certainly. There was a point in time I was flying fighters. We were going to war in Kosovo, I think it was. Anyway, I'd done this, many times before, Desert Storm and other stuff. But this time, I had kids and I was in that situation where I had a lot of people dependent upon me. So I think I had like three separate $1 million policies. And one of them, all these insurance companies, they kind of, whatever, when you apply for insurance. Anyway, they kind of knew that I was taking out multiple policies, and one company that this lady dressed up like a nurse, and she came over and she was drawing my blood and all this other stuff, and they're very serious. I mean, because my behavior. They had all these things about, do you scuba dive? Do you? And I do some of those things, but mainly, blood pressure and smoking and being an alcoholic or something else would that's the kind of things they were looking for, things that were going to greatly reduce your life expectancy. But anyway, that can be a portion of the application process. So term insurance, this is what I've been talking about. Life insurance is provided for a specified time, does not build any value. If you don't die, you don't get a dime. You pay them $50 a month hoping you don't die. If you do die, the heirs get $1 million. If you don't die, you get nothing. You just walk away and you're happy. It's like car insurance. You didn't crash the car, so they don't give you any money. Premiums on term insurance, yeah, however they want to be set up, but they're usually quite affordable. Determinants, yeah, longer term, the higher premium. Older the policyholder, definitely your propensity to die goes up. Greater the amount incurs, as it should be. Males tend to die not only younger, but they also, whatever. And whoops, especially in wars and other things like that, they tend to go a little quicker, or jobs that tend to kill them. Premiums for higher for smokers and medical issues, obviously. So this is all straightforward. And this would not be different than the other insurance programs. Any insurance program is going to charge more for people that do risky things or are unhealthy. So, yeah, it's going to get astronomical, unaffordable. Here, down 20, 40, $50. And then it starts to spike. But again, your dependents should be in your house, and if you're saving for money for kids' college, you're 55. They either did or they didn't. Those costs are kind of water under the bridge at this point. Yep, gets more expensive as you get older. Males and females. So pretty straightforward stuff. Easy to understand. There's no hidden whatever. It is what it is. Now they can do a couple different things where they keep the payments the same, but they pay less over time if the premium remains constant. You'll also see a lot of life insurance policies kind of built into like credit cards or mortgages, and they'll act like they're doing it for your good, and they kind of sort of are, but really it's because if you die, they don't want to be out there fighting with the grieving widower to try and settle things up. It's such a small chance that you're going to die during the course of that mortgage that they'd rather just have a separate policy for it that they've got factored in and you're actually paying for. Group, yep, typically cheaper. Again, if you can get it at work, something like that. Whole life. So now we get in these complex things, and to try and explain the difference between whole, permanent, universal. It's like it's whatever. Maybe you can get a free lunch or a free dinner by sitting down with the agent, they go through their whole spiel. But this type of insurance can get pretty expensive. I'll show you some of the examples, but let's say $600-700 a month. But they're like, oh no, but this is also your investments as well. So if you want to go that route, you can, but it can be it can be detrimental, um, as the investing with an insurance company typically doesn't have the same sort of rewards as a straight brokerage investment firm. Has a cash value because yeah, you're giving them quite a bit of money. Whole life premiums, same factors, just like I said. Yeah, there's certain that have just a certain time where you pay quite a bit, and then oh, you're all paid up, and you don't have to pay anymore. Well, you've given them tens and tens of thousands of dollars. Let's hope so. Comparison to term insurance, higher premiums, obviously. Accumulate savings, whole life premiums remain constant. Right. So it is what it is. You're gonna have to make some decisions in life. But if you're looking at people like Dave Ramsey or some of these other financial guys, if you can, bear to listen to some of that stuff, I think pretty consistent. Anybody who's not in the business where they're earning a commission on the stuff and that's giving you, fiduciary advice will generally tell you term is the better deal. So universal, what happens is some of these investment products don't do as well as they want. People, oh, it's, whole life is horrible. So, I don't want whole, oh, no, don't worry. Don't worry. We've got universal life now. We just changed the name and universal gets a bad name. Let's call it variable. Anyway, I'm trying not to be, you know, super cynical and pessimistic here, but I'm not a big fan. Variable, what it was meant to do was, different types of investments. Oh, we can invest in the market, and we can invest in other things, and don't feel bad that your yield's not as high. We'll put it in some more aggressive investments and get you a better return, perhaps. How much life insurance do you need? So they're going to have some different things here, and tell you the truth, there's only, it's not rocket science. It should be kind of common sense here. For example, if you do this thing where they're talking about, oh, income 10 times your annual income. Well, are you a single guy? Are you married with 9 kids? How is that reflected in this calculation? It's not. So how accurate can this be? So you're going to have to do a little bit more, kind of akin to what I was talking about. Going, okay, I have, 2 kids, and I hope for them to go to college. So that money, if it was available now, let's say 100,000 per kid, and the outstanding mortgage on the house is 300 grand. So okay, we need a half a million minimum. And then my spouse, kind of took time off to raise the kids, maybe not super employable right now, needs, whatever, 2 years to readjust. So a couple 200,000 extra for that. You're kind of spitballing things because that's what you're doing. You're forecasting. But you go, anyway, I'm doing this. It looks like I need about 700, 800, call it $1 million. Well, you can get a policy, and there you go. And then, 15 years down the line or 10 years down the line, you're going, man, this insurance, the premiums are going to go up on the term insurance now. But, I've already set aside money for the kids' college. I've already got half of the house paid off. So guess what? I only need a half $1 million now. And so I'm going to lower the amount of, the coverage. And so you can just match it that way. So they'll also have a budget method here, annual living expenses, special future expenses, debt, job market. So this one is pretty close. This is what they're talking about, needs method. So anyway, when you go to some of these sites, you'll see something, simple like this income method, and it just doesn't have common sense implied in it. Using the internet. Okay, obviously these guys are enamored with the word, you know, the interwebs or something. There's garbage in, garbage out. You gotta do some sort of needs assessment. The internet may be nice that it's going to give you, some helpful reminders, and you plug in little boxes, and it does the math to calculate your needs assessment. But it's going to be needs, so doesn't anticipated. Yep, family income may not rise. Weak economic inflation. oof. But again, if you got the money in today's dollars and you invested it, say your children's college 15 years down the road, if you give that money now, you're going to see investment and interest rates go way up in terms of what banks are willing to pay you to keep money because inflation. Um, yeah, Life and Health Insurance Foundation. I think those folks may be steering you to one of their more complex products from one of their more whatever agents who fund that. But uh, do your own research. Um, so again, it's not like your family's supposed to have won the lottery here. And so you can see how this kind of puts whatever the some of these things like life insurance for minors, and it's just wrong. There's no point in that. A life insurance for a college student, unless you're already immersed in life, but no, life insurance should be based upon the requirements of your beneficiaries, your dependents. So, so beneficiary is that person who's going to receive the money. Grace period. Sometimes there's a grace period if you can't pay the bills, things like that. There's also they can also use the term grace period in the fact that hey, if you up and die in the next month, um, the policy's not in force. Um, anyway, living benefits. This is kind of nice where let's say somebody's diagnosed with a terminal illness and they're struggling and so they've got a very limited amount of time to you know cover some bills and get some things done before they pass on. So rather than wait for them actually to be dead before they get some of that money, it would be nice to have a provision where some of that money can be payable earlier before they're passed on. Non-forfeiture clause. This applies to a whole life policy. Sometimes you can take loans against it if they have cash value. Obviously, not for a um, term policy. Incontestability clause. So yeah, after a certain length of time, if they say, hey, you looks like you were smoking or something like that, if a year or so has passed, or they say, oh, you had an existing medical condition, some of these incontestability clauses you just have to read, but it's just tough luck for the insurance company. They have to pay up. Renewability option on a term policy to where it can where you can renew it without much drama. Conversion, convert a term policy into a whole life policy if you wanted to do that. Settlement options. So again, how that money's going to be paid out to the beneficiaries. And then the lump sum versus. So this is not too different than the lottery payments. Where you get a smaller amount up front, or you can get a larger amount over a series of equal payments, and then interest payments on the other part. Selecting the insurance company. So yeah, AM Best is a company that they're not an insurance company, but they rate the company. So you'll see a lot of these third party companies, whether in stocks and stuff like that, you'll have, Standard and Poor's and Morningstar rating mutual funds, AM Best rating this. Anyway, there's different companies and they rank the financial solvency of the company. So you may not be familiar with the name of the company, but if they're highly rated by a legitimate, not JD Powers or some industry sponsored thing, you actually want a company that is their business. All right. And then quickly, I realize we're kind of getting on in time. We're going to run through some investing fundamentals. We're going to spend a lot more time on this stuff going forward. But yeah, first see where you are. If you've got a bunch of debt, you need to get rid of your at least the if it's credit card debt, yeah, don't. don't start investing while still paying credit card bills. There's no way you're going to make enough money to pay that off. Um, and then, yeah, don't put yourself in a hole. You need money to live off. And I've had many a short-term investment that ends up being a long-term investment, and you just kind of do with less. But I wasn't necessarily overextended. There are some crazy folks out there, especially in crypto. You'll see people because like I say, buying a home, it's very normal to buy homes on margin, basically. Where you buy the home using borrowed money, completely respectable, reasonable. But to get in the stock market, that's buying stocks on margin, which can be devastating because if the price fluctuates, and then crypto. But yeah, there are a number of people who have bought crypto. Well, they're probably no longer in the market. They've probably been stopped out and lost it all. So anyway, be careful about speculative investing. Well, speculation and investing are really two separate things. Speculation is, trying to make a quick buck, and investing is more disciplined, more of a longer term approach. So money market securities, that's kind of a parking place for money, especially with inflation doing what it's doing right now. These are insured by the government. The government's pretty stable. We talked about risk, risk and reward. If you're not exposed to very much risk, don't expect very much in terms of reward. So that's why they're kind of flat. Stocks, common versus preferred. I'm not going to go in a huge thing on this. It's just stock represents a position in a company. You bought a little chunk of that company, right? And you own an equity position. Now, whether it's common stock or preferred stock, it's just not a big deal. It only even applies to companies that are paying a dividend. And so a company that's paying a dividend, and so those would be like income stocks. There's different ways to make money in the stock market. Sorry, we have to kind of go in depth here just a second to kind of explain why common and preferred stock. But stock, like on the exam where the lady bought the stock at a low price and she sold it for a high price. That's one way to make money. And then the other way is if the company's a larger company and they're no longer necessarily expanding and they've got profits, they pay them back to the shareholders in terms of a dividend. Small companies, high growth companies, they don't do that because they reinvest those dividends. Well, not dividends, reinvest those profits. They don't pay them out as dividends. So anyway, if a company's kind of hurting and they're normally a company that you got involved with because you wanted to get a dividend, and all of a sudden they're hurting and they can't pay a dividend, well, that's not a great company, and I wouldn't want to be necessarily sticking with them. But in that transitional period before you got away from that company, if you had common stock, um, you would be the first one not to get the dividend. And if you had preferred stock, all that means is that they would have to pay you a dividend before they could pay it to the common stockholders. But anyway, not a great situation because that company is, next time, next quarter is probably not going to pay anybody a dividend. And then it may be going under. So all sorts of bad things can happen. Anyway, I'm not a income stock investor for the most part. I am a growth company investor. So primary and secondary markets. So let's say you want to buy some Ford shares, and Ford Motor Company or something like that. If you happen to work for Ford, or maybe you're some, Ford fanboy, you might be able to write to the company and buy the stock directly from them. But in most cases, no, you're going to be buying it on a stock exchange. So it's kind of secondhand, but it's not like it's not like a secondhand car. It doesn't have scratches or anything. Who cares where it came from? It's just as good as the stuff that came from the primary, which would have been the company itself or their, bank. No, you probably bought it from, somebody else who owned it previously. So IPOs, Yeah, a lot of hype on IPOs, initial public offerings, when a company was growing and they're privately held by just a few investors and they decide to take it public. But you kind of got to know somebody and you kind of got to be somebody. If there's a big IPO coming out, don't be frustrated that you're not able to get in on it because nothing's fair. The big banks can take care of their preferred clients or take care of their high wealth individuals and anyway, you're probably going to be able to get in on that. Well, you will be able to get in on that first day, but it's probably going to not be at the initial public offering price. Now, it could be higher, could be lower. Anyway, so secondary markets, again, I don't know why they go in depth like this right off, but secondary markets would be like, NASDAQ or uh, New York Stock Exchange or something like that. Just whatever. Not so important in a digital age. Who cares? It's all done, with electrons. There's nobody in a stock pit yelling out, orders anymore. So, types of investors. So there's really three types. They make day traders look like a separate category. Now you have institutional guys. Those are people like, say, the people who, uh, manage the PDF, the or the Alaska, the Permanent Fund, or the PFT, sorry, PDF. Um, Maybe big, you know, union funds, maybe teachers, pensions funds, big boys that are just, they've got other people's money and they're investing it. And closely related to portfolio managers too. Portfolio managers are would be say the big banks and stuff. So anyway, there's basically if you want to split it up even further, there's kind of the big boys and then there's the individual investors. So the retail investors, the small guys. And it's supposed to be semi-fair, and things like Robinhood and some of these other platforms have sought to make it more fair. But as you saw probably from the Wall Street bets, the whole Reddit thing, that some of the big boys do not like when the individual guys kind of gang up and try to play some of the games that the big investors do. But day traders, that's why I say it's not really a category. Day traders, that could be anybody who it's just people who are making the market. They're just in and out, typically in the same day, and those people tend to get wiped out quite often. The number of day traders tends to change quite a bit. I think a puppy just changed the slide on me. Alrighty then. So we talked about types. We talked about bonds. So, like I said, if you buy stock, you're buying an equity position. Now, a company, when they want to raise money for expansion or whatever, they'll sell stock. They may decide though that they don't want to sell stock, that they don't want to, dilute their ownership, or they don't want to, have anybody else with an ownership stake in the company. And so, or they may be a government who can't obviously sell stock. So they'll just do a loan type situation. And that loan, in this case, would be a bond. And so a bond, it's kind of a promise to pay. Let's say, you as an investor, you've got 20 grand in this business says, look, if you loan us your $20,000, we'll give you your $20,000 back in whatever, 10 years, whatever the terms are on the bond. And in the interim, every year we'll give you a bond, payment of whatever, say, $1,000 or something. So not only do you get your whole 20 grand back, but you get these bond payments every year. And you don't own the company. You have just, given us a loan. So that's how bonds work. Mutual funds. Mutual funds. Let's say you're, wanting to buy stock in a company, but you said Apple's the greatest thing ever, and so you put all your money in Apple. Well, whatever, they come out with a phone that's not a good one or whatever, and Apple stock tanks or dives, and whatever, you've got quite a bit of risk because you're all in on one particular company. Um, what you might have wanted to do is say, well, there's a lot of other companies out there that make uh, cell phones, and I know, regardless of what happens to individual companies, the whole cell phone sector is not going to go down. So you may want to buy, branches of different companies. I think I picked a bad example here because, things like whatever Samsung and Ericsson and some of the other ones. There's not that many other viable companies out there, but and they may not necessarily be listed on exchanges that you can buy from. But probably a better example would be maybe a hard drive manufacturer, and you for some reason think, you want to get involved in hard drives or computer technology, and rather than just buying, one specific company, you could buy across a whole range of companies. Or say you wanted to, invest in a certain region, either globally or even within the states, you can find a mutual fund that has a collection of stocks. So really, it has to do with a diversification tool where a fund manager will, own a large number of stocks and then basically repackage it and sell it to you as individual stocks. We'll have a whole section on mutual funds. I think I confused some people there. Um, what are we talking here? Publicly traded, so that was a continuation of mutual funds. We'll talk about index funds and other things. And then also real estate is a great investment. Return from investing in stocks. So just like I said, income stocks pay a dividend, and then growth stocks, typically you're counting on the price. Now there can be an income growth. I mean, they don't have to be absolutes of either one, but generally they fall into different categories. So growth stocks, they're not paying a dividend because they're growing. And income stocks, they're usually larger, more mature companies that aren't expanding any longer. Bonds, so you get the coupon payments and then the bond price appreciation, which can happen. Bonds, you can resell them. And so if you have a bond that's paying at a certain price and, paying 3 or 5%, and all of a sudden new bonds are only being offered for 1 or 2%, well, you can sell your old bond for a bit more money. Um, Investing in mutual funds just depends on the underlying stocks, and then real estate, as we said. You don't have to get this wrapped up about it. Basically, you know, buy low, sell high. That's it. Buy, sell it for more than you paid for it. If there's a dividend, yeah, getting back to the example on the test, if she bought it for one price and sold it for another, and then got, say, $50 a month in dividends, you would add those dividends in there as well. Different tax rates. So remember the short and the long term taxes. So that being a year, if you're making money and you're doing it like say as a day trader, it's all going to be short-term gains, so it's going to be taxed as ordinary income. If you're long term, you kept it for more than a year, then you're going to be paying about 15% on it, so typically about half. And that's what they're showing here. Like I say, we'll spend more time on this later. Standard deviation of the volatility of the risk. Measure range of returns. So anyway, there's a concept in investing, and it's called beta, which refers to the volatility. Because say stock prices fluctuate, they'll bounce all over the place. It doesn't. When you say a stock is volatile, volatile compared to what? It's sort of like a uh, boat in the ocean with the tide going up and down. It's going to vary. So if one boat happens to vary at a higher rate, that would be you know significant. But if it just stays with the regular tide, then that's not as useful. So anyway, the Standard and Poor's a broad range of stocks that's in a stock index. It by definition has a beta of one, right? So that indice, when it goes up and down, that is one because that is what defines beta. So the way this makes sense is if you say, you're looking at stock like, let's say, Shopify, and it ends up being more volatile than the Standard and Poor's index, it would typically have a higher beta. So it'd be a beta of 1.3, which means it's, 30% more volatile, that the price changes 30% more radically than the market. Or let's say a company like General Motors, a big kind of sluggish company, it probably has a lower beta because it price doesn't change quite as much. Anyway, risk and return. So small firms tend to have higher growth. Yep, especially new startups. I mean, 9 out of 10 fail in the high tech sector. IPOs, yeah, can have high risk, and especially that first day because they're guessing, trying to set that price. The initial public offering. I mean, they do their best guess and they set a price, and only the market can determine what the price is going to be by the end of that day. Risk and return trade-off among bonds. Yep, large firms, low risk. High risk bonds or junk bonds, obviously you have to have a higher return because more prevalent to have those default. Mutual funds, um, on a whole, will typically be less risky because of the diversification. But if it's a bunch of small stocks, yeah, it's going to have some risk. And anyway, you have to do your homework. You have to know what the underlying securities are that are owned by that mutual fund, which is all laid out in a thing called the prospectus, which we'll talk about when we get to mutual funds. Real estate, yep, all kinds of things can happen that compared to the stock market, you know, dirt never goes to zero. Companies go out of business. Real estate, you know, you can get in trouble, and definitely in certain markets, but by and large, real estate is um, quite a bit more secure. And you don't have to necessarily select one. You want to have some diversification again amongst investments, having some real estate. I've always done that where I'll get involved in the stock market, maybe make some money and realize this probably isn't going to last, and then dump it into real estate, which seems to work. Borrowing to invest. It can happen, buying on margin, but investing in real estate, that's the norm. Um, Investing in stocks, probably not a good idea. Taking risks to recover, double up to catch up, yeah, typically doesn't work out. And then the term project. Kind of burnt out after reviewing the test and everything else. Um, My diction isn't so good tonight anyway, so we'll talk more about the term project, but it is the time to start thinking about that. This is all in the syllabus, so take a look at that. And again, just use it's forecasting. You don't know where you're going to be, but you need a plan. You need a plan that's probably not going to be perfect, but it's way better than no plan at all. So jump right in, get on some of the websites, the brokerage websites, dig into their questions and their planning tools, and the thing should kind of write itself, hopefully. And that's it. Good night.